I don't think it would be hyperbole to say that ASML is one of the most important companies in the world and probably one of the least known by the general population. The company makes the machines that make it possible to make the semiconductors or the computer chips that are powering everything in our economy, especially AI. And that company, ASML, reported earnings before the market opened today. Now, as you can see, the company has had a fantastic run so far this year, with shares up by over 60%. But the company reported earnings that were largely very positive, and yet the stock isn't moving. And there's a very good reason for that, and that's what we'll get into in this video. My name is Brian Stoffel. At the time of this recording, I don't own shares of ASML. I want to give a shout out to Fiscal AI for sponsoring today's video. More from them in a second. So this is going to cover ASML's second quarter of 2026. It's roughly in the ballpark of a $700 billion company. All right, let's do the headline numbers first. Revenue came in, this is in euros, 9.3 billion euros. That's up 21%, and it came in ahead of both analyst estimates and the midpoint of management's guidance. Earnings per share of 7 euros and 58 is up 28%. That also beat estimates. And it's important to note that what management really guides for is gross margin. And that's really important because we're talking about just selling a couple hundred machines each quarter that are used by the likes of Taiwan Semiconductor. And so you got to know who has the pricing power, who has the upper hand, who has the leverage. And so management guided for a gross margin of between 51 and 52%. It came in at 54%. That is very, very good news. So as you can see here, the gross margin expanded, operating margin expanded, net margin expanded, free cash flow increased by a whole bunch, net income was expanding as well. And the balance sheet, those are dollar signs, they should be euros. They still have 5.6 billion euro against just roughly 2 billion euro in debt. To get an idea for where the leverage really exists here, let's go down this income statement, and it is a little bit telling. So as I said, revenue is up 21%. Here's the thing, there's two different revenue lines. One revenue line is more lumpy, and that is selling the extreme ultraviolet machines that help make these semiconductor chips that power everything that we use these days. That was up 17%, but the bigger the installed base of these machines that exist gets, the more maintenance and field option sales that is going to become part of this, and that is relatively more stable. That was up 32%, showing you how much the installed base has grown over the past year. So that was what was going on to get sales to go up 21%. Importantly, the cost of those sales was only up 20%. That's where those gross margins came in that we were talking about, and it's why gross profit actually grew faster, albeit just slightly, than revenue. Here's where the real leverage comes in. If you can grow your revenue by 21% and your operating expenses only jump 8%, one of the nice things about just having a few customers is you don't have to spend a bunch on selling or marketing. Really, a lot of it goes towards research and development. But overall, those were only up 8%, which is why income from operations jumped 30%. Now, overall, net income was up 27%. And importantly, the number of shares outstanding was actually down 1% during the quarter. So what else happened during the quarter? For that, we're going to head to Fiscal AI, a tool I use literally every day. If you'd like 15% off an annual membership, second link in the show notes below will bring you right there. So what I wanted to pull up over here on Fiscal AI is, again, these two different revenue streams. And look, this really tells the story. The orange tends to be more reliable, more stable. That is kind of your service revenue. And overall, that's been growing by about 29% over the last 2+ years. System sales only growing 8%. But again, this is very lumpy. So it's important to understand the different dynamics at play here. If we look at system sales, they have been accelerating. They were actually down 6%, but now they were up 17%, and there was some commentary on the positive momentum here continuing, which we'll get to in a minute. The service revenue, I think this is really nice, seeing it rebound here. So that has been growing very steadily as well. It's those field options that really cause a little bit of the variability there. So it's not strictly service revenue, but that was the first thing I wanted to point out. The second is that there's two very broad categories of machines that the company sells, and it's EUV and DUV. The DUV is the deep ultraviolet, the EUV is the extreme ultraviolet machines. So what this shows right here is just the total number of units sold of each one. So if we look at the EUV, which is the red, those were growing 45%, which is pretty nice. They are a smaller part of the unit shipments. If we look at the DUV, again, this tends to be cyclical. It is moving in a direction that is quite encouraging. So that's good to see. The last thing I just want to bring up here is the company's gross margins, because they really do play a big role. But what I'm going to do now is I'm going to pull this out to look over the last couple of years, because I think it helps to look at this over a longer time frame. Because what you see here is that, of course, semiconductors have always been important, but there is a clear inflection, kind of starting with the pandemic, because the supply chain got interrupted. We were short on chips. And when we were short on chips for even things like automobiles, we needed to increase our chip production. And so fabs like Taiwan Semi, like Samsung, like Intel need more of these machines. But now we've entered an age where they need it not just for consumer electronic goods, but for AI, for data centers. And we see that those gross margins have expanded upwards. And there was some concern about the newer versions of this, the NA EUV machines, having a lower margin profile. So far, that has not shown up. So that is good news for investors. Another thing that I think is really important came in the commentary. Basically, this is a way to look in what's going on with the AI trade in general. And what management had to say is that there is strong demand for logic and memory chips. You can't make those logic and memory chips without ASML's machines. And their customers were accelerating their capacity expansion plans. That's no surprise. We've heard about Micron. We know Taiwan Semi's building in Arizona. We know that Samsung and SK Hynix have agreed to increase their capacity. And so importantly, based on that momentum, ASML is planning to add 30% to their low NA EUV capacity. In other words, they're going to produce more machines throughout the rest of this year, and their DUV capacity. And they're investigating increasing their capacity for 2027 and 2028. All in all, it just means that the demand continues to be very strong for this. Now, let's turn to guidance, because if we look at guidance, you might be surprised that the stock isn't up even more. Management guided for a midpoint of 53% growth year over year, 11.5 it should be billion, 11.5 billion euro versus analyst estimates of about 10.4. That's significant outperformance. And they're guiding for 55 to 57% gross margins, and that's versus a 53.7 in the year ago quarter. So all in all, this looks very, very encouraging. Now, I don't own shares of ASML myself, but if I did, I would definitely be watching that revenue guidance, because that revenue guidance gives you some visibility not only into what's coming for ASML, but also what's coming for the AI and semiconductor industry writ large. The second are those gross margins. They are very, very important. Third, the company does have some of its revenue at risk, because they're aiming for about 20% of their revenue to China, and any type of restrictions that governments put on selling these machines to China can affect the company. They're staying right around that ratio right now. That's important to keep an eye on. And then finally, free cash flow. Look, this is one of those companies that by and large is without a peer. And so the moat is just super wide, and the demand for AI chips just means that it's widening. And the thesis is very much on track. And so a lot of people might be wondering, well, given all this, why is the stock trading for as little as it is? Well, before we get to that, I want to let you know I've been tracking my portfolio over the last 10 plus years. It is beating both the NASDAQ Composite in the yellow and the S&P 500 in the red. And if you want to learn more about my method of investing, I encourage you to join our program, Stock Investing Mentor. That's the top link in the show notes below. Now, there's 3 parts. The first is 1 hour of live weekly training every Thursday at noon Eastern. It is recorded. The second is full access to my real-time portfolio, so you find out what I'm doing, when I'm doing it, with a full explanation of why I'm doing it. Third is 24/7 access to a private online investing community. And oh, by the way, there is another part that comes with it. Now, if you join Stock Investing Mentor, you get access to Stock Simplifier Pro absolutely free. This is part of the package of buying Stock Investing Mentor. This is a product that's worth about $300, $400 that we're giving away for free to become a member of Stock Investing Mentor. And what I want to show you is why the stock is not reacting more positively to these developments. Now, we could look at ASML's trailing PE ratio, and if we did, we'd see that it's at about 56. That's way above kind of its historical average. But what I really like to look at is do a reverse discounted cash flow analysis with ASML, because if we do that, and I want to show you this, if we give them a 3% terminal growth rate, if we give them a 10% discount rate, and let's assume that it's the company's free cash flow margins can actually hit 33%. Right now they're at 28%, but we're going to optimize them to 33%. Now, if we do that, then the company needs to grow their revenue by 22% per year over the next 10 years to justify today's stock price. Now, remember that, 22% per year over the next 10 years. Here's why I want you to remember that. Because we can go over here to Fiscal AI and we can say, okay, well, what does revenue growth look like now? What do analysts think it's going to look like in the future? What does it look like in the past? And so what I want to show you is that over the next couple of years, the company is expecting 21% growth this year, 26% growth next year, but then analysts are expecting that to go down to 14%. Remember, this is very, very lumpy, this revenue is. So over the next 3 years, the average is right about with what we were hoping for of about 22%. Kind of more important than that is if we pull this back and we just say, hey, let's look at the last, 21 years here. What is the median growth rate that this company has had over that time? And the answer is at about 11, 12%. Again, this is very lumpy revenue. So one of the main reasons the stock isn't up more is just because there are huge growth projections already baked into the stock, much more than the company has had in its previous iterations of itself, in its prior lives. The average is about 12% growth, and we're saying it needs to grow at about 22% over the next 10 years. Now, obviously, the AI infrastructure build-out could make that happen, but that is by and large why the stock isn't reacting even better today. I want to point out that this version of Stock Simplifier is not live yet for our Stock Simplifier customers, but it will be by the end of the month. So if you want to join that with Stock Investing Mentor, top link in the show notes below. Let me know what you think of ASML's earnings and how you're approaching it moving forward in the comment section. Till next time, Brian